So what I see is a situation where as industry is consuming more for solar panels, for the war machine, for electronics, electric batteries. I just see us getting to a point where, that silver demand, I can see us in the future mining 4-to-1, 3-to-1, 1-to-1. And it's why there are some speculators or investors that are calling for $300 silver.
If we come back to current markets, in the days when we had a silver standard or a bimetallic standard, the relationship between gold and silver was roughly 15 or 16 ounces of silver to 1 of gold. Today, we're looking at a ratio of 80 ounces of silver, 88 ounces of silver to 1 of gold.
Silver is standing at a critical juncture, both as an industrial metal and as a monetary asset. Demand is being driven higher by solar panels, electric vehicles, electronics, and even military applications. At the same time, supply dynamics are tightening as the mining ratio between silver and gold continues to shrink further away from historical norms. In past centuries, the natural balance was closer to 16-to-1, yet today we mine roughly 7 ounces of silver for every ounce of gold, and much of that silver is consumed and not recycled. Furthermore, global inventories are shrinking, leaving the market vulnerable to sudden price fluctuations. In fact, just 50 million ounces taken off the market could catapult silver into new all-time highs in US dollar terms, as it already has in most major currencies. AlasdairMacleod, a respected economist and strategist, emphasizes silver's historic undervaluation compared to gold and its dual role as both a medium of exchange and a necessity in modern industry. Shawn Khunkhun, CEO of Dolly Varden Silver, brings the miner's perspective, highlighting how companies are expanding aggressively, raising capital, and making discoveries at a time when the broader precious metals sector is showing signs of resurgence. Together, their insights suggest a market where silver is not only undervalued, but also poised for significant gains as investors shift from gold to silver, replicating a pattern observed in past bull cycles. Silver's setup is one of scarcity, rising demand, and monetary relevance. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I've been following gold for 2 decades professionally, and what I saw in recent years was the gold price was hitting record all-time highs in all currencies except for the US dollar, if you went back to a few years. And then that phenomenon occurred in the US dollar. So right now, the same can be said for silver. In every major currency, let's take our Canadian dollar, for instance, the price of silver is at a new all-time high. It's only in USD that the price hasn't moved beyond the old $50 high. I suspect that's coming. We've got a very, very tight market right now. If you look at the LBMA, if you look at where inventories have come down to, if you look at the demand for the industrial side of the metal and the monetary demand, we are in a very vulnerable moment right now. We are 50 million ounces away from a price squeeze. If you look at inventories and if you look at how the product is hedged, there's really, if somebody were to take 50 million ounces on delivery, I think you'd see silver at a new all-time high in US dollars. It's already there in every other currency. As more generalists come into the space. Silver historically has been a metal that once gold has put in a big move. And we've seen, gold and gold equities really outshine almost every other asset class. As that trickle down occurs and as the generalists come into the space, they're often priced out of gold. High net worth retail investors. Gold is almost unattainable for the average investor, whereas silver isn't. And so as those speculators and precious metals enthusiasts come into the market, they gravitate more to silver. And that's why I suspect in this next leg of the bull market, like we saw back in mini bull markets of 2020, 2016, major bull market of 2011, silver dramatically outperformed gold. If we stopped mining gold, for whatever reason, all the gold we've ever mined, which only fills up 2 Olympic-sized swimming pools, vanished. We could function as a world without gold, but we couldn't. It would be highly disruptive if silver was taken out of the equation. And so if you go back to history, there is a 16 to 1, silver is 16 times more abundant than gold. But because over this last 5,000 years, we've been mining and mining and mining, we're now at a point where we're mining 7 to 1, not the natural relationship of 16 to 1. So we're mining, for every 1 ounce of gold we mine, we only mine 7 ounces of silver. And again, the silver's being consumed. And because of the price, because you've got a 90 to 1 silver to gold ratio, we're not recycling silver in the same manner at the same percentage that we're recycling gold. So what I see is a situation where as industry is consuming more for solar panels, for the war machine, for electronics, electric batteries. I just see us getting to a point where that silver demand, I can see us in the future mining 4 to 1, 3 to 1, 1 to 1. And it's why there are some speculators or investors that are calling for $300 silver. I think we've been in a universe where it's been central banks that have been buying gold. And really, apart from 2 recent central bank purchases, central banks have not been known to buy silver. So I think, the central banks have been buying gold. The market really hasn't come in and caught a bid under silver, which is why I still think we're in the early innings of this gold bull and precious metals bull market. GDX, which is the index that owns the major gold producers, just on Friday of last week, finally got back to its 2011 high. Gold was at less than $1,900 when it hit that 2011 high. Gold today is over $3,500 an ounce, and the stocks have just gotten back to where they were 14 years ago. If you look at GDXJ, which is the junior miners, they still have another 50% to go before they replicate their 2011 high. Silver equities have actually done better than the junior golds, but they haven't done as well as the senior golds. Now, historically in bull markets, both silver and silver equities drastically outperform gold and gold equities. I look at $25 silver as a marker where most of the industry is not incentivized to develop or explore.
Yeah.
$25. And we stayed below that price level. If you go back to April of this year, we were there for about a decade. So in that environment, we had to be aggressive and bold to go out and build a business in a time where we were in a depression. Now that we've poked our head through 25, it's an environment where our cost to capital is lower, right? So we went out and raised money at the highest price we've ever raised it. We've used our revaluation in our shares to go and make accretive acquisitions. So we're getting bigger. We've increased our land package by 600%. We've gone from 2 past producing mines to 5. Raising money. We've started the most aggressive drill program in the company's history. We've got 5 rigs turning. We're doing a 55,000 meter drill program. And what that's translated into was last Tuesday, we put out a drill hole, 1,422 grams of silver over 21 meters. It's the best drill hole in the company's history. So I agree with investors. We're in an instant gratification world, so investors want it yesterday.
Sure.
So I agree with you. But the reality is, BC, and again, it's taking a look at like Canada or British Columbia and talking about these big areas. It's really regional. And so when I think of the Golden Triangle, I think about the indigenous communities like the Tahltan and the Nisga'a who want industrial projects. When I think of the permitting in British Columbia, we had the Artemis mine, which is propelled with the Blackwater mine, which has propelled Artemis to a $6-7 billion valuation. That was a mine that was permitted, that was brought in on time, on budget. Osisko Development's Caribou project was given the green light. Eskay Creek, the Skeena project is being advanced. So BC is advancing projects, but it's all regional. Does the community want it? Does the infrastructure support it? And so we've been very happy. The government has turned around our permits in a timely manner. As long as you're respectful to water and the indigenous communities, you get your permits. It was something that I debated with my board for many years before we made the decision. You know, there's things to think about. There's a higher cost of legal, accounting, the liabilities go up. So it wasn't something we didn't do without heavy debate. But my thinking was over 93% of North American capital is concentrated into the U.S. I spend a lot of time, here we are in Colorado. I spend a lot of time in the U.S. talking to U.S. investors. They cannot buy the Canadian listing companies. They need NASDAQ and NYSE listed codes. So we've opened ourselves up to the biggest market in the world at a time where precious metals are irrelevant and silver and gold are breaking out. So what I hope to achieve is, look, if I'm a U.S. investor on the New York Stock Exchange, there are 10 ways to play silver. Dolly Varden is one of those 10 ways. The name of the game in the stock market is liquidity.
Yeah.
Right? We've seen our liquidity dramatically increase. Yesterday was a day where we traded 1 million shares in the US. That's $4 billion US dollars. If you compare that to the Canadian listing, we did maybe 1.5 Canadian dollars. So already we're seeing volume and we're seeing, the market gravitate to that NYSE listing. ETF inclusion, index inclusion, that liquidity all helps. We're in a universe right now, David, where over 50% of money is passive, right? We are now able to absorb that passive money.
Silver's story is deeply tied to the evolution of money itself. For centuries across Europe, silver was the foundation of monetary systems until the late 19th century, when war reparations paid in gold enabled Prussia and then the wider European continent to transition fully onto the gold standard. Even China remained on a silver standard until the late 1960s, underscoring how long silver carried weight as actual money. In Roman law, the distinction between money and credit was first defined, with money being the final settlement of debt, while credit was simply a promise. Silver, alongside gold, fulfilled that role for centuries, and Britain's own pound sterling was literally a pound of silver before debasement eroded its meaning over time. This historical context explains why silver retains monetary relevance even today. When gold became dominant under the British gold standard, silver still served as legal tender. Fast forward to now, and the gold-to-silver ratio has blown out from its historical 15-to-1 or 16-to-1 balance to 80-to-1 or 88-to-1, a divergence that signals undervaluation. If fiat currencies continue to weaken, silver is positioned to reassert itself as a secondary but crucial monetary metal. Its affordability compared to gold makes it accessible to the broader public, ensuring strong demand once confidence in paper money wanes. Let's get back to the interview.
The background to silver is that in Europe, it was a monetary metal until about 1870. And what happened was, in the wake of the Franco-Prussian War, Germany or Prussia managed to extract war reparations from France in the form of gold. At that stage, Prussia and associated German states went off. Silver standard went onto a gold standard, and other European nations on a silver standard did exactly the same thing. So that was the thing. It's also worth remembering that it wasn't until, I think it was about 1968, that China came off a silver standard. So it was on a silver standard well into the last century. So it is associated as a monetary metal. Now, if you look at history, monetary metals actually do tend to evolve. If we go back to the first evidence of a monetary metal in Roman law, we go back to the time of the 12 tables, which was 448 BC. And the currency then, which really grew out of the 12 tables, was called the AES, A-E-S, in modern spelling. Now, that was 1 pound of sort of copper bronze coin, as it were. And ice was 1 pound. And that's where we get today, the sterling 1 pound. It was, in our case, it was a pound of silver. So that was the origin of it. Gold came in later. Gold has always had the sort of the precious value associated with it because it's incorruptible. I mean, there's no point going over all that sort of stuff. You can read about it elsewhere. But it emerged, if you like, under Roman law as the favored form of money. Now, the difference between money and credit was actually defined in the wake of the 12 tables by various jurors particularly in the 1st and 2nd century AD. The jurors confirmed were Gaius. You also had Ulpian and Paulus, the 3 jurors who were really instrumental in defining the difference between money and credit. Money was always final settlement. In other words, when debts are discharged completely, you have paid for it in money, and that has cancelled all debts. Everything else is credit. Now, the banking system evolved out of Roman law, and the banking system evolved on the basis of credit. What is a bank? It's a dealer in credit. I think that's an important point to understand. So as things evolved, if you like, then we had, the introduction of silver standards. In the case of Britain, under William the Conqueror, we had silver standard, sterling silver standard, where a pound was a pound of silver. It got changed, if you like, debased through time. I mean, Henry VIII was one who debased it, etc. You had other problems like coin clipping and so on and so forth. And we finally came off a silver standard and went on to a gold standard, really unofficially, I would say, in the late 18th century. But by the beginning of the 19th century, we'd really evolved onto a gold standard marked by the newly produced sovereign, which first came out in about 1817. The gold standard was formally applied in the early 1820s, and that ran through all the way to the First World War. The interesting thing is that credit expanded and contracted under the British gold standard, but you could always change a Bank of England banknote for gold coin. And even to this day, the legal requirement on a Bank of England note is for the bank to promise that exchange. Now, the exchange is suspended. But the point about silver was that part of the arrangements whereby we went on to a gold standard is that silver remained legal tender for an amount up to £2 or 40 shillings, as it was described. Now, if you look at the sovereign today, the sovereign is worth roughly £650. So that shows what's happened to the paper pound, if you like, to sterling. So if we went back onto that sort of relationship between gold and silver, you would see silver circulating for amounts of under £1,300, which is quite a significant figure today. I mean, £1,300 is, you can buy quite a lot with £1,300. It'll keep you in groceries for half a year. You can see that, if you like, is a relationship. No, it's a reasonable supposition to suggest that if we get a collapse in paper currencies, fiat currencies, and gold then becomes, again, as under Roman law, which it still is, if you like, the basis of the whole monetary system, then there is going to be that role for silver. Silver will be a secondary monetary metal to gold. No doubt about it. I mean, think today, if we've got one sovereign, which is somewhere between a quarter and a third of an ounce of gold, I mean, it's not a big coin. That's worth £650. You're not going to be able to go into a store and say, I want to use this to pay for my groceries or whatever. But you will use silver. You see that this relationship actually is still important. We're a long way from this actually happening in terms of travel, if you like. Now, in terms of time, I don't know. I mean, it could happen quite quickly. But you can see that silver still retains this important role. Now, if we come back to current markets, in the days when we had a silver standard or a bimetallic standard, the relationship between gold and silver was roughly 15 or 16 ounces of silver to 1 of gold. Today, we're looking at a ratio of 80 ounces of silver, 88 ounces of silver to 1 of gold. So this is very, very far from the situation where fiat currency effectively collapses and we have to have a new, if you like, means of exchange. So this is, if you like, the attraction of silver in the markets. As we see the increasing risk of the failure of the fiat currency system, of the two metals which are going to accelerate most to reflect this, obviously it is silver. So this is where Egon is right. And if you look at the charts, I mean, you can see the momentum under the silver price at the moment has been really spectacular. So we're talking about a metal which is not really in very, very great supply. And bear also in mind that because this is, if you like, the poor man's gold, if we can sort of use that slightly pejorative phrase, then the demand for it is likely to be very, very substantial as the general public wakes up to the situation. So we could rapidly see that gold-silver ratio, the number of silver ounces to gold, falling from the current 88, 87 down to below 50, down below 30, and in an ultimate collapse, maybe even below 20. So it makes a lot of sense to have some silver. It really does. But the principal sheet anchor to value, always going to be gold. So that's your top. But if you really want to catch up with what's happening, silver will help you do that.
Central banks and large institutions are not speculating. They are positioning. While most headlines still focus on short-term fluctuations, a move away from paper claims and toward tangible ownership, the steady migration of physical metals into stronger hands is not a random trend. It reflects foresight and preparation for a very different financial landscape. When you consider history, every major shift in global monetary systems has been preceded by years of quiet accumulation. The British, the Americans, and now the BRICS all understood that monetary power rests on what you hold, not what you promise. Today, silver and gold represent that anchor once again. The widening gap between spot price narratives and actual delivery trends suggests an inevitable repricing event ahead. This is not just about metals, it's about resilience, sovereignty, and understanding where value truly lies. Those who act early secure not just wealth, but independence in times of transition. If you've followed this far, you already sense what's at stake. Stay prepared, think long-term, and align with what history shows us always prevails. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.